Hello value investors, thank you for joining me. Today I want to talk about Zscaler and what's interesting about Zscaler. My name is Michael from Deep Value Returns on Seeking Alpha. So I want to discuss with you in this video about what Zscaler is, how the market has changed towards high growth companies in the last several months. We're going to talk about what's really attractive and what investors are really looking for. Then we're going to discuss one of the blemishes in the results, and then we're going to just bring this all together and talk about its valuation. So let's get started. The thing is, right off the bat, this time last month, so we're now just kicked off July, and the cybersecurity names have just trounced the Nasdaq, and many high growth names have just done the same thing. They just bounce back. So any concerns about inflation and whether these companies that were beneficiaries from the work from anywhere trade, whether they come up against tough comps from last year, all those concerns seem to have gone. So, as I say, animal spirits have been unleashed. Now, here's the thing. It's not without reason, right? So, Zscaler is growing at a very fast rate. You can see here on the screen the guidance for last quarter of this year is for 48% year-over-year growth. That's probably even conservative because, management tends to be conservative. Furthermore, billings are up 71% year-over-year. Billings are an important metric because it tells you how much revenue is going to be booked over the next several quarters. So it's a leading indicator. Investors really like to see that. And if billings are strong, that means that there's still a lot of pipeline to go. So on that front, everything is very good. The one thing that I'm kind of not so much sure is that on a non-GAAP basis, that includes adding back all those pesky costs like stock-based compensation. On a non-GAAP basis, the company is guiding for approximately 8% for the upcoming quarter. This compares to 6% last year. Now, if you think about it, it is a 200 basis point expansion and it is moving in the right direction. But if you think about how much the company has grown, at some point, you do want to see, with all the pesky costs added back, the company turn substantially profitable. I'm not talking about free cash flow where they kind of getting the deferred revenue getting the deferred revenue up front and getting stock-based compensation as a non-cash expense. So I'm not talking about that. I'm just talking about the underlying profitability of the business. Okay, just before we summarize everything up, so the company's priced at 33 times forward sales. If you look at CrowdStrike, it's very much on a similar range there. Both have kind of the same, kind of the same growth rates. Now, in the case of other cybersecurity names, for example, FireEye is spinning off half its business. So it was the hardware business, and what's left is going to be just a software business, and that business is growing much slower. It's growing about 20% CAGR, but it's priced at approximately 10 times sales. So it's quite a drop, or quite an increase. It has the potential to go from 10 times sales to 15 times sales or even 20 times sales, versus what's the likelihood of Zscaler going from 33 times sales to 45 times sales. So there's a lot less wiggle room in my opinion here. Anyway, if you want to know which stocks I own and why, don't forget to check out my marketplace. It's called Deep Value Returns. I'll tell you the stocks I own and why. You're welcome to do a totally free trial to see if it suits you. I'll see you next time.